Welcome to the Dividend Talk podcast, episode 122. How we avoid the fear of missing out. Hey guys, welcome back to another episode of Dividend Talk. This week, European DGI and I will discuss FOMO. How do we avoid it? Do we even have it? And if so, how do we not fall into that trap? All that and more. See you on the inside. Hey, European DJI. How are you this weekend?
Very, very well. Sunday morning this time, right? Not on a Friday
Yeah.
evening, but I think you are partying. Actually, I also had a small party yesterday. My headache is gone just, so I'm good now. But tell me, how was your party?
You can probably hear my voice is still a little bit, I would say, raw. So I'm getting old. I can't drink as much as I used to. Sometimes it was a leaving party in work, so one of the guys was leaving. Sometimes they're tame, and then sometimes they get a little bit out of hand. And this one just seemed to drinks were flowing. I would say it was a good night. Good way to celebrate the colleague. It was worked with him for 4 or 5 years now. He's a big personality, big part of the company. So it was nice to say goodbye and wish him well in his new ventures. But look, I'm excited for this Sunday morning. Sore throat, but I'm still ready. I'm still ready to roll this out with you. I think it's a good topic. We have lots going on in the news. I know it was a jam-packed week, so I can't wait to get into this and unravel what's after happening this week.
Yeah, and then they say like when you're on a frugal mindset and such, you can't enjoy life. Well, I think you're proving it the way around.
you can. Hey, look, if you were doing this every week, you would say something, but it's once in the blue moon is perfectly okay in my book.
Yeah. Well, hey, let's get then straight into the news of the week, right? With a full packed episode. And the first news item that caught my attention, and I don't know how many people actually know this. As you know, I've got a holding in VTRS, right? Their earnings were quite well. But on Thursday, I believe it was the FTC or the SEC that intervened because the CIO was doing insider trading. Effectively, he was handing over information to one of his colleagues or peers, which allowed them to easily make $1 million. And CIO is out now. So definitely we have a rotten apple there. It's not good for the story of the stock, right? I mean, it didn't do anything to the share price. It just based on earnings and everything, it just went into the sky, and also with the latest CPI numbers. But this is not what you want to see, right? I don't know anything else about the board of directors there, but the CIO is usually a little bit, specifically in pharma, a little bit the loser at the table. Yeah.
So I mean, it is a little bit of bad timing with it coming out. I know they had a decent enough earnings, quite similar to last quarter, I believe. But they've also said now that they are acquiring 2 more companies. I can't remember off the top of my head. Family Life Sciences was one, and something with an I start, I think. But I think it's just unfortunate this comes out. My worry is, and like you said, you hope it's only one bad apple. In my experience, there's generally more than one bad apple. He may have been getting that information from somewhere else. You don't know. And then you also have to question how these guys get caught. I'm sure he's not trading himself. He's getting someone else to do it for him. So how in God's name did they get caught? So I mean, it's ridiculous. But like you said before the show, if it was the CEO, I'd have a little bit more.
I would have probably sold my shares.
A bit more of a bigger concern. But it looks like they're doing the right thing. They've nipped it in the bud. He's on leave of absence at the moment, which we know was probably the highway to getting the hell out of there. So that's
hopefully into jail, right? They really need to punish them hard and up into jail.
I mean, it's the only way you stop something like this from reoccurring. Because if he gets off lightly or a small fine or whatever he gets, what's gonna deter somebody else from doing that?
Yeah, exactly.
Absolutely nothing. Yeah.
But I also can imagine, like, if you're the CEO and the people you handpicked, and one of them is a bad apple, I think it also does something to you, right? Uh,
Yeah,
you
yeah.
can't
Now
trust the people you appointed.
I know this was a merger between, say, Upjohn
Yeah,
and Mylan, some
Milan, yeah,
Pfizer. Yeah.
yeah,
So you'd wonder the breakup. I don't know the exact breakup of where the CEO, which side the CEO came from, or
Mhm.
where all the board members. I'm sure it's
Yeah,
amalgamation of both. Hopefully, from the CEO's perspective, he came from the other side and he didn't know too much about him, and then this is a shock, and he moves on. But let's look.
yeah,
Let's see. I'm not too worried now. It seems like, look, he was caught. They're getting rid of him, and let's see if anything else comes out of it in the future.
yeah, good. And then the second one, we had few podcasts about earnings in the last 3 weeks, right? Like we always do every quarter. But this time I wanted to still highlight one of my all-time favorite dividend stocks, Ahold Delhaize. They reported earnings in the last, in this week, effectively. They have a deleted earnings of 70 cents, and this was an increase of 31% year over year. With Ahold, you need to look both at the earnings and the cash flow. The cash flow doesn't tell an entire story on its own, and the earnings neither. So you need to always look at them in conjunction. The free cash flow was positive. Year to year, it was a reduction, of course. This was already a known working capital, like all those companies have this year, right? But they still expect to make 2 billion by the end of this year in free cash flow. And if they achieve that, then both their buyback and their dividend payouts have been fully funded again out of hard cash, which is just amazing. They also again announced a new 1 billion share buyback program starting in 2023. It's again 1 billion. They are doing 1 billion a year, and this 1 billion is becoming way more effective over time, right? Anyway, it's again another 3%. So take this 3% plus the 3.7% dividend yield that you have now already. You're talking about a 6.7% shareholder yield if you don't look just at the price, potential price appreciation or whatever comes with it. I think it's already a little bit in the top range of my value. Nevertheless, if you look at this more from a dividend discount model and you just expect the dividend to grow every year with 4 or 5%, then I think this is still a good place to nibble in at times. For me, it's definitely in the reinvestment pocket right now because I think, like I said, probably in the high end and around the fair value. So, they just keep on delivering. What is probably also good to mention is that the CEO doesn't want to pass all the costs on to the consumer because they know that the consumers are price sensitive at the moment. So they already announced that they will take some of the inflation cost on the chin and absorb it into the business. Also looking at further cost reduction to absorb some of that. And of course, the US business is doing strong, and with the current dollar, also they had a lot of favorable impact there. But they are really nicely reporting on this as well, and how to keep that out of the how to keep it transparent for us. What is FX impact and what is pure earnings? So good numbers again. I'm really really a big fan of Ahold, as you know.
And if they're taking some of these costs on the chin, like they said they're going to do, you would imagine in the next 2 quarters you're going to start to see that hit the top line and bottom line in some form. It has to, if they're taking these costs. So there might be a better time to buy them than right now, because they're basically telling you they're going to take some of these costs. It has to reflect somewhere. And investors, we have short memories. I know they've wrote it down in black and white, but when you see the top line and the bottom line being affected, the share price usually follows.
Yeah, but this company has a history of under promise and over deliver, and I think these guys are smarter than that. Maybe they start positioning some of the Coca-Cola brands a little bit lower on the shelves and put their own household brands on the height of the ice, and which is higher margin but still cheaper for the consumer, right? So I expect also this game to be played. So I don't know if this is only for the cosmetics to announce this. Let's see. It's
Look,
really in the upcoming earnings.
it's an interesting take. As I said, the next two quarters will be definitely something to keep an eye on, to see how they're actually managing and controlling that, and if they are indeed going to over deliver on this case. But look, as you said, solid earnings overall. I'm with you there, slightly on the higher end of my valuation as well, but you still get a 3.5% starting yield with them. As we
Exactly.
know, we're both fans of the company, so we can't really say much more than that. Speaking of dividend hikes, we've started doing this recently, and we have another 20% dividend hike this week from our company ADP. I think that's their 48th consecutive year in a row now, so nearly a
Yeah.
dividend king, and a 20% dividend hike.
Yeah, it's amazing. 2% yield right now, right? Forward. So that's a bit setting me off. But we have spoken about ADP in the past, right?
Yeah.
Here. And weren't you having a stake in them one time, or was it APD? I always mix them up.
I always mix them up, and no, I had APD. Yeah.
APD, so not ADP. Yeah, so, and this is the automatic data processing company, right? So it's always where the payroll numbers come from and everything. So look, multiple 35, a bit hot for me. But, if you can do a 20% hike, you're beating inflation. So to all the shareholders of ADP that are listening to this podcast, congratulations. With that holding, you're beating inflation again. Like last time, Snap-on, ADP, I mean, these are really dividend darlings.
Yeah. And we've had a couple more hikes as well. Dividend aristocrat Aflac, ticker AFL, hikes it by 5%. Look, it doesn't beat inflation on current numbers, but it's still a decent raise.
Yeah,
I do know Tiago is a huge fan of this company. I wasn't following their earnings this quarter. I know there was some with Japan and the yen. I think that may have impacted them a little bit, but I mean, it's quite a solid company.
Yeah, and then the last one, Becton Dickinson, I think is also worth calling out. Ticker symbol BDX, also hiked their dividend with 4.6%. So, Met stuff is a little bit more difficult, I think, now also in this inflationary environment, but still to do a 4.6%, I'll take them. I don't own any of these three. I was, looking at AFLAC around 45. I never pulled the trigger. Of course, I regret a little bit with that, because last year I think they did also, what was it, 20% hike?
Yeah.
So overall, this AFLAC is really, really churning out all the time nice dividends. If you look at it from a decade point of view, yeah, maybe another time.
Cool.
Okay, then, there was also, let's go a little bit towards the main topic and what inspired us. So Simon Stott, hi Simon, one of our active members on the Facebook group, and the link to the Facebook group we'll put in the show notes if you want to join the conversation. He had a really interesting post, and he said, as the end of the year approaches, could it be assuming to have a small award ceremony for acts of financial foolishness? And he says 2022 seems to be fully loaded with this one. And his top three were the quasi-mini budget that triggered a derivatives-fueled near collapse of the UK pension scheme, the Unilever board offering 50 billion to buy GSK's consumer health business, and then the third one, GSK refusing that offer and then floating the same business, Halion, for 20 billion less. And then he asked, are there other financial acts of financial stupidity? Well, I really love this one because we see this all the time, right? And it's driving me nuts sometimes. I can really get triggered by this. So, then many mystery response there about the borrowing of huge income multiples to buy properties that one could never really afford. Yeah. And I thought like, wow. And what about this week with FTX? Right, this crypto exchange that went effectively Chapter 11, that went bust. I mean, there's so much shit going on in the market sometimes, and a lot of this you could have seen, right? I made a video about Unilever, 50 billion, that it was way overpriced. I was really happy that they took it away. We have often been talking or getting questions around crypto. We know that many dividend investors have also crypto in their portfolio. We had Celsius also this year in trouble. Now FTX, and also Thiago and OMS asks us about it. And for me, it's like, I don't understand this stuff well enough. For me, the first question is already, why invest in crypto? Yeah. So I understand that many people have that there, but that's where also FOMO kicks in. often, and we both, I think, have been looking at crypto at the past. I never invested in it because I can't explain it to myself. I understand blockchain, yeah, and the power of it. I just can't translate it into crypto and the value of crypto
Yeah.
behind it. So, and then that's my issue here. And if I don't understand something, I try to avoid investing in it, as an example. But if you then look at FTX going bust and so many people now again not being able to access their money effectively, right? And also the chain reaction that creates in the whole industry. I mean, what a shit show going on there.
Yeah, yeah. I mean, look, it's easy for the two of us to sit here and say, look, we're dividend growth investors, invest in dividend growth stocks, and don't have FOMO. That's just not how it works. And you touched on it. We both have had FOMO of some sort over the course of our investment life, and particularly as we do the podcast, we get so many questions about different things depending on the trends that come up. So the key is, how do we manage our FOMO? So FOMO is obviously fear of missing out, and how do you manage these? How do you manage these expectations, and how do you move on and stick to your main plan? And I know you're going to challenge me on this, because I definitely can't sit here and say, look, I'm purely a dividend growth investor, because I do always have that little origin, that little devil sitting on my shoulder saying, let's do this. But I think the key thing for me is, I have my core plan, which is dividend growth investing. I invest the same amount every month, and that has, as my wages has increased over the last 2 or 3 years doing this, I have increased that in tandem with that. That's a non-negotiable for me. I put the same amount in regardless what's happening in the market or what's going on around, and that's my core plan. I do have extra money on the side, and then I would put a little bit extra into, say, something like option trading. I've done Bitcoin, I've crypto, and so on, and I put that in there. But that's money that I'm truly allowed, not allowed, but comfortable with losing. It's never a huge amount of money. It's not thousands and thousands. It's more like hundreds. it's the smaller scale. So I scratch my itch that way. I did have Bitcoin. I said I truly regret it. I spent ages getting Bitcoin. Got one full Bitcoin, then sold it for some shit coin, and then Bitcoin took off. And you learn from that. But I think the biggest thing for me is risk tolerance. And I think, myself included, when I began this, my biggest learning was, I don't think people are really truly honest with themselves in terms of their risk tolerance. Before I started, I think I spoke to you about this before. I tried to trade FX for quite some time. I came from a background of trading sports, which I was quite successful at. Thought I'd move into the financial world, make a lot more money, and I'd be retired sitting on a beach with my wife now, which was not the case. But I do remember that feeling in my stomach when I lost 5 figures the first time. It was gut wrenching, and I would have sat there beforehand saying, I could lose that money. I'm quite comfortable with it. I wasn't. I was not one bit comfortable. So I think a lot of people are in a similar position. You are looking at the reward, and you're thinking, this is what I'm going to get, and you're ignoring what the actual risk is. And let's be honest, the risk in most of these FOMO surrounded kind of assets like crypto, the real risk here is 100% gone, and not even, it doesn't even taper down. It's usually gone in an instant. There's one bit of news, bang, your money's gone. And we've seen this when crypto. This must be the 3rd or 4th example that we've seen something around this. It's an unregulated area, so you have to be aware that the risks are a lot more than what they are in traditional investments.
So what you're saying is, like, you don't mind, putting, let's say, 30% of your monthly salary, into your dividend growth portfolio, because you have learned and you've burned yourself in the past on these items.
Exactly, and I'm using quotes here. I would classify that as safe, even though we do know those risks. But I have wrote here that it's time proven. We know that dividend reinvestment accounts for, I think it's 85% of the total returns. We know this works. I do know I'm picking individual stocks. I could pick 40 of the wrong stocks, so that there is risks there. But I don't think we would see a collapse of the same scale as we see in crypto without there being a complete meltdown, and we'd have much bigger problems than what we have in our financial banks.
Yeah, but what you're talking here about is also, you say time proven, right? And we
Yeah.
also always say like the history is no guarantee for the future. So where do you get all this trust from in your process? Because it's a lot of money that you're doing every month, every year, and it's really the long game. So where did you build the confidence that this long game is indeed going to deliver on those promises that you have in your mind?
Yeah, I don't think you can always be 100% trustful or confident. Look, we're dealing with financial institutions outside out. We don't control the regulations. That can change in an instant. We do know that, say, the Hero IBRK, they have protection up to a certain amount of money depending on the bank. I'm not even at those levels of money
But that's
yet.
on
So
savings money. That's not necessarily on your holdings. And for
so
instance, you don't know if they have really put their holdings into this legal
100%.
entity, right? Yeah.
100%. But I don't think anybody can 100% say that they trust each financial institution. You can't do that. But you do have to use history as your guide. I mean, they say history doesn't repeat, but it rhythms. And we've seen that.
Yeah.
We've seen crypto since its infancy. Boom, bust, boom, bust, boom, bust.
Yeah.
People losing all their money, hacked, all this sort of stuff. This has always happened. You can see it with dividend growth investing. You can see boom bust cycles, but you also see companies. We just spoke about APD up there. 48 years of consecutive dividend increases. That's increases. That's not even just paying them. So we can see history as a guide there. So you have to have a little bit of trust, but I don't think you can trust it 100%. But I would much rather have control of picking my own companies than putting it into a pension fund who does everything for me and then takes a huge fat chunk of my money.
And then for you, option trading is really, to address that inner need of speculation, I guess.
Yeah, I mean, I love it because usually I'm quite conservative in nature. I'm quite structured. I'm a Taurus, and Taurus likes routine. But there's always that little side of you that likes to go outside the box and do something a bit different. That scratches my itch. I'm not too involved in crypto. I mean, I've learned my lesson from Bitcoin. I was getting greedy. Option trading, I've changed, and you can see that over the time. I've evolved in how I've done that. I've started off pretty much like I start off everything all in, greedy, looking for the higher returns, and then you get burnt and you learn over time. And now it's all revolved around companies that I either have in my portfolio already, or I would not mind holding for a period of 5 to 10 years. So it has evolved. Still high risk. There's still bits that I can improve on, but it's a lot better than where I was 2 years ago with that.
Nice. Yeah. So for me, I mean, it's hard, right? FOMO and I often wonder myself, right? You see sometimes those kids on social media getting rich overnight, and then I think like, what the fuck am I doing wrong? Yeah, like you see them doing that, and then within 3-4 years they're financially independent, and then I think like, why am I doing this for 15 years? Yeah, but often I notice those are also people. Actually, those are more like what they call influencers, financial influencers.
Yeah.
Can't even pronounce this stuff. But then when you really look at their performance of one of the bigger names, actually where they get the money from to invest every month is because of a very profitable YouTube channel. Yeah, so they can distribute so much money into it that it's really hard to see what their real performance is, and people are not transparent in their performance, right? If you look at the great ones, this financial, I don't even know how they are called anymore, but all this gang around this Graham Stephan and everything, they're not transparent around it. They talk always about their total value, but a lot of that comes from YouTube income and affiliation. Even FTX affiliation, like Meet Kevin and everyone. But sometimes it does happen on me because I see their advices, I see what they're doing, I think like, oh my fucking god, how can these kids be driving all these sport cars and doing this overnight, right? So it does get to me. But then these stories, like what happened this week, where they all are getting exposed with where this money came from, and from those commissions and everything, just gives me a good lesson. Like, I wouldn't even be able to watch myself in the mirror with this stuff, because it impacts my own core values. And what I always do like that, and it sounds maybe like I'm an alcoholic or something like that, but I just open up my dividend tracker and I just look at my dividend growth charts, and I think like, remember, EDGI, this is why you're investing. This is why you're doing it. This is why you're different, because I so much love the cash coming in every time. I really wish that on the Hero they would have this, and that they would give you a notification when the dividend comes in, that you could configure it on your iPhone, that you only hear ka-ching all the time. Ka-ching, ka-ching. And it should come when you're working, right? When your phone is on your desk, that you least expect it, and then ka-ching, you think like, this is what I'm working for and investing for.
Yeah.
So for me, it's really hard sometimes. Yeah, these feelings do touch me, but I'm so far able to bounce them off.
But I think it's easier for you to bounce them off because of where you are in your journey. You've spoke about not money values, but in terms of what you have now, what you're earning from dividends is meaningful contributions now. It's nearly maybe 2 or 3 months worth of actual deposits from you. So it's meaningful. You log in, you can see it. Okay.
Yeah.
You're in year 1, year 2 of this journey. You're not nowhere near that. So you're not seeing meaningful. You're maybe seeing maybe 100, maybe 200. And then you see these same guys on YouTube driving the cars they're fancy. It's a lot more difficult to trust the process or open up your spreadsheet and say, hey, what I'm doing here is working, versus 7 or 8 years into your journey, when you're looking and you can see something concrete there. So where you are in your journey is probably helping a little bit there as well.
Yeah, that definitely. And if I reflect on the first 2 years, right, let's say 2014, 2015, it wasn't much different. Yeah. Of course, I would say in the last 3-4 years, either I spent more time on social media that I got aware of it. But, the first 2 years were for me I was reading up everything around dividend and value investing. So I didn't have the mental bandwidth to even look into other stuff. So I think that has also, during that period, really prevented me from even looking at other things, because I was trying to understand my core strategy even that I was developing. Yeah. So and if I would now start and be fully subjective to what's all the shit that is on social media, I think it is much harder now today. Because, for instance, the crypto boom was hardly being mentioned in 2014, 2015. Growth stocks were not really a thing at that time. It was more like there's no other alternative with the zero interest environment than to invest. Yeah, and maybe even dividend investing was also a popular trend at the time. But what I've learned as well, right? So I'm generally contrarian. So when I see all this stuff, I often think like, automatically I want to choose the other path somehow. I have this always in life. Yeah, I'm never going through the normal path. When there was just a sidewalk, I was always trying to walk over the line, see if I could balance, or jump on the street in the water. So I've never walked the normal path. So that helps me also. But at the same time, and this is also how I look at dividend growth investing. We're cheating the hell out of the whole system, right? And how society's set up, because we're investing for cash flow. We have people working for us that spit out the cash flow back to us, and we get it at a favorable tax rate. So for me, this is already contrarian to all of the people living in my street and all my people around me, let's say in my family. I'm cheating on them, right? So from that point of view, I feel relatively good. But I also, now that I'm longer in the journey, I also start to really understand what Buffett say with circle of competence. Yeah, and this is really important for me. First of all, I had to dividend growth investing had to become my circle of competence over time. It wasn't like I started with that day one. I'm now just better at it. I don't think I'm there yet. I mean, if you know the dividend growth investor, I mean, for me, he is like the gold standard, right, when it comes to dividend investing.
Yeah.
And so I'm not there yet, but I know that if I keep on learning, I will get there. And I'm not anymore at the phase that I can learn from a book. I need to learn from my mistakes, evaluate them, attention span, all these kinds of things, right? But still, like you, I have this little, sometimes this hooker money, let's call it, reserved for myself, 10% of my portfolio. I think I should stop having it as 10%, but more like an absolute number. Let's say maximum 10K of my whole portfolio, because while the portfolio is growing, this 10% becomes more meaningful. But I think I should keep it to 10K or something like that. That allows me to invest in Alibaba when I think it's deep value. For me, that is already the fear of missing out, right?
Yeah.
Yeah, and that's how I'm trying to get into to avoid fear of missing out. And I've kind of put a cue in myself when I feel this, to go to my dividend tracker and just look at the Hero account and Interactive Bros, see what dividends came in, update my tracker, and then I become calm again. It's like a drug to me.
Yeah. But I think we do have to mention the role social media plays in all this. Maybe, I know you spoke about 2014, 15. Social media was there, but I don't think like FinTwit wasn't what it is there
No.
now. So the pressures weren't there. You also, YouTube is growing as well. It wasn't the same as what it was.
Yeah.
You've got a lot going on. I'm not very trusting, very easy. So I could watch someone on YouTube, and in my mind, yes, they say I've made 4,000%. I don't believe it straight away. I want to see proof. I want to see facts. I like people who are open, who are honest, who will admit to their mistakes, show their actual journey. You don't have to show me the exact numbers, but you have to show me the journey. You see a lot of these people on Twitter, and we used to I don't post on Twitter a whole lot anymore, but we used to joke, and we used to do experiments, and I used to put out something that well thought of, facts and all this, and I get zero engagement. And then I tweet something 2 days later and go, up dividends, or dividends rock, something stupid with no sense, and you get 20 retweets, 200, and it was ridiculous. And it's kind of what has pushed me not away, because I still follow some people, but I don't post as much, because I just feel like, A, I'm going to post shit that's no value to me or no value to anyone else. And B, when I post something meaningful, nobody gives a shit. So I just kind of just read everyone else is where I'm at. But I just think you need to be careful about who you're following and why you're following them. I mean, someone says my stock's up 200%. Do some digging. Do these people have a history? Have they shown you before the run up? Have they spoke, or have they just come online just as this wave is taking off, and they're just riding the wave? I mean, how many accounts have we seen come and go with the growth stocks phase, with the crypto phase, with everything? We've seen it come and go. So I just think you need to be careful on social media. I'm also glad that you mentioned YouTube. I'm going to blow our own horns here for a second, but you do see a lot of the time people making more money off their podcasts, off their YouTube, than what they're actually making. And I think that's wrong. I honestly don't mind them doing that, but some people are intentionally setting up that way. I don't think that should be the case. I think if you're adding value, you're showing your journey, and you're giving something back, whatever money you make is completely fine. But if you're going out there to run a business and just spout usual shit on YouTube just to make money without adding value, I don't like that at all.
Specifically, if you make money out of the sentiment and knowing very well that there's a fear of missing out. So all those people with the faces that are crying and like this fear on the normal stock, I think it sells. Yeah, it sells. And I noticed that as well with thumbnails, right, on my own YouTube channel. If I put an attention mark behind something, then it already gets more clicks than something else. So and it's us who are clicking that, right? And I fall victim to the same sometimes.
But how many times have we been approached with sponsorships with so on
continuously?
And
I don't do that stuff.
We could easily have made money. We don't make money from this at all. We could have made money from it, and we could have definitely increased the amount of people that listen to it, because it's part of fad. But I think, and one thing I like doing this show with you is we both have core values, and that I could not look at myself in the mirror knowing that I'm ripping people off. That's why I'm completely open and honest. My blog, which is a little bit neglected, but I did post all my figures at the time. It's a little bit outdated, but I was posting my monthly purchases, my monthly sales, my mistakes, what I did. Do you know what I mean? And I put it all out there, and I've no problem doing that. But I really don't want to go and pump crypto and earn 10K, because I'm ripping people off, and I just can't. I can't stand that. So
Yeah.
I would just be wary of who you follow on social media. Follow anyone you like, but just be careful of what they say. Not
Yeah.
everything is what it seems out there.
And call them out, right?
Oh,
Because I've also some good, and we know that we are also in touch with some of those people that are, let's say, quite successful on social media. And sometimes I see them that they're stepping out of their value. Yeah, you know those people, you know them from the conversations, you know that they are really great people, and then suddenly you see them drifting off, and I usually just send them a DM and call them out, like, hey, what the fuck are you doing? And then you just see that they got caught up into the fear of missing out as well. For instance, myself, I've got now 12,000 followers on social media, on Twitter, right? When I started, I mean, there are people now with 80 or 90,000, 100,000 followers that started later than me, and just post a lot of junk around dividend investing. Yeah, and how you say it? It's easy to fall into the same trap, to start doing that as well, if you want to get follower growth. But why do you want to get follower growth in the first place? Because if you need follower growth, if you want to get, let's say, advertising revenue and all these kinds of things, if you want to sell stuff, but that means also it will become a full-time job. Yeah, so yeah, you really need to understand why and what you're doing it for.
I can vouch that you call people out, because I don't know how many times I'd say to you, hey, I've done this, and you're like, what the fuck you doing? So, I can vouch that happens in real life. But I mean, look, FOMO was there. It's real. I think it's normal. It's always going to be there, especially with social media and everything we see. But managing it is important. And for me personally, I think being honest, don't do it the way I did it, and and lie to yourself and say, I can take this much risk. And then when it happens, you can't. I mean, you really need to have a real think about what your money's doing, where you want it to be, and what would happen if you lost it. What impact would that have on you, your kids, your wife, and have a real think about that, and then make your decisions based on that. But certainly, if you want to make money fast, you can on crypto. You certainly can, but you can also lose money just as fast. So you have to be careful. Okay, good topic. We'll move on to, we still got quite some questions, but we also have a portfolio review. I think we were meant to do this maybe on the last show or two, but we are finally getting it to it. So it's Javi has sent in his portfolio. Quite a diverse portfolio. There's a list of about 20, 25 companies, but I'll just name the top maybe 5 or 6, and we'll get some thoughts. So we've got Facebook, 3M, Starbucks, Intel, Alphabet, Amazon, Nike, and Texas Instruments. I think I named 9 there, but that's his top 9 companies. So what are your thoughts on his top holdings and his overall portfolio?
Well, let's say like that. I don't know when he bought them. Yeah, that's maybe an important disclaimer. But if I look at this, it seems to be a turnaround play in the top 5, 6, because Meta, Facebook. I mean, we know that where the stock price went, it crashed like 70% over the last, what is it, a year?
Yeah.
Then we have 3M, litigation issues. Starbucks, I think that's probably the high quality in here. But also Starbucks, if you bought it at the beginning of this year, it was also with the outing of the CEO. Then we had Intel. Well, we've spoken enough about that as a turnaround play. And then Alphabet. So I think it's, first of all, what I really like about this portfolio is that it is really a growth portfolio more than dividend portfolio. And why I like this, if you're in your younger years and you truly believe in that tech, the current big tech is still there to stay 20 years from now in its own power, I think you're really set up well for the future. Facebook, the biggest position, it's an interesting one. I think when you share the portfolio, Facebook was way higher in share price than it is today. So I still hope that Javi is not getting nervous. But for me, the interesting ones are more in the tail end of his portfolio. where he has also, Texas Instruments, Verizon, AbbVie,
Lockheed.
T. Rowe Price. I think high quality names in here. No, popular names in here, but not all high quality, I would say. And because it has also AT&T, Disney, which is probably more of a value play than a dividend play. Yeah.
You took that last sentence took basically what I was going to say right out of my mouth. A lot of popular names here, particularly on FinTwit, and it's, do you know what? Something I've noticed over we're doing these quite a while. I think we've only got maybe one or two unique portfolios where there were companies, not the popular names. We got some with a lot of Swedish companies and so on, but I don't know, is this what social media is doing to us? Like everyone seems to be in the same type of companies. You mentioned you like to go the opposite path, but we're starting to see lots of people with the same types of companies all the time. Nothing wrong with them. I'm not saying there's anything wrong with the companies, but it just seems to be everybody's doing the same things, going on the same companies. It's one of the reasons I admire Decline Capitalist, actually, because he almost goes out of his way to pick companies that you either never heard of or that are completely different. But to answer the question about the portfolio, Facebook, when I saw that, first of all, I was thinking, okay, when did you buy this? They have dropped in price. Were they 12% after the drop in price, or did you buy them when they were after dropping? So that would be a concern. 3M is a concern for me because of their litigation. And again, we're talking about the top two companies is 20% of his portfolio. And I see huge risk there. For me, that is just too high. Starbucks, I know you're a huge fan. I'm starting to slowly get on board. Probably
a huge fan of the CEO.
Yes.
And of the time when buying. Yeah, I'm not I'm fan like IBM when it comes to their debt profile. Yeah, so it's like a two-headed monster for me, Starbucks.
Yeah. Then we got Intel, which we mentioned is a turnaround play, and then we have Google, which is also one of these growth stocks that is severely going down. Those, what's that? 5 companies make up 40. It's hard to see the numbers there. Maybe 40-50% of the overall portfolio. That just looks too high to me. It looks too risky. But again, I don't know when you bought these. If you bought these on their all-time highs or when they were higher, maybe it is a bit of a problem. If you started to buy them at this moment when they're down 50-60%, maybe it's not a problem. But for me, that's too lopsided for me.
Yeah, so I have a thought here, and this may be to Javi that submitted it. And sorry for Javi for saying this, but you come to Dividend Talk to ask for feedback on your portfolio, and you have then in your top 5, you have like Facebook, Alphabet, and Amazon, and let's say top 6, I guess, in there that are in your top, let's say in your top 50%. It's kind of awkward on the face of it. So maybe my feedback is, while we said you have a lot of popular names, and I really believe that this portfolio, if you look at the snapshots from today, can really perform well in the future, right? That's really what I think. But the question is, are you a dividend investor? Dividend growth investor, or are you just a general stock picker? Because it sounds from your portfolio like you're a stock picker, or maybe you're just recently started the journey of dividend growth investing, and then maybe you want to reallocate your top 6 a little bit into more quality dividend growth stocks.
Cool. Again, we try not to be critical. We just give our actual opinions of it. As we said, I think a lot of good names there, but I just think the weighting of the top half or the top 5 or 6 is a little bit heavy for my personal liking. Of course, if the growth stocks outperform us again in 2023, you could be sitting there laughing at us driving a Lambo. But my personal experience would be to maybe even out the top half a little bit, just bring down the reliance on them.
Yeah, good one. Okay, thank you, Javi, also for having the courage to submit it. And if there are others that also would like their portfolios to be reviewed by us, feel free to submit them. Send us a message via Facebook, via the Dividend Talk Facebook group, or just approach us on Twitter. Having said that, let's go now to some of the listeners' questions. And the first one comes from Marek Nazarko. And he had a question for the podcast, like, do you use the Chowder rule, or do you see the Chowder rule as important? Because some well-known dividend stocks like Realty Income, Chesnara, British American Tobacco, Walgreens, Intel, da-di-da-di-da, they don't pass the Chowder rule.
You have an article on this, don't you, I believe?
Yeah.
Because you use it quite a bit. So maybe, yeah, maybe you answer this question.
Yes, I do feel it's really important, but I look at it in conjunction with the others, with the other metrics. I said the Chowder rule over time has proven, or from the back testing showed that you're really talking about value plays then. Yeah, if a company yields 3% and grows the dividend at 9% on average, and on top of this has a decent payout ratio, you're having golden hands. So that's how I look at it. The thing is, there are not so many stocks that typically pass the Chowder rule. Often the stocks like Snap-on maybe would pass it right now. Yeah, 2 point something percent yield, 2.8 plus 12% or 13% 10-year annual growth plus how is it a 30% or 40% payout ratio. So that's an example, and that's why I'm such a fan of Snap-on at the moment. But usually there's not enough choice for me if you look at the last few years in this high price environment.
Okay. Martine has asked us, do you have a silly habit that always wants you to have and buy even number of shares?
Yes. It's like if the share prices are expensive, like Allianz, let's say, I can only do like 10 and sometimes I do 8. Yeah, I did.
Yeah.
But then I need to do 7 the next time, so that becomes 15. I couldn't deal with 16 in my and if you have if you do sometimes reinvest those dividends, right, with some stocks,
yeah,
you get like this 76, and then I feel like I have to buy 24, yeah, to get to 100.
No, I don't mind that. I do know there's people out there that don't like odd numbers on their volume when they're in the car turning up the radio and so on. I have a friend like that, but I don't mind. I did have this weird obsession for a while, wanting to get either 50 or 100 shares in that company. But the more expensive the company, the harder that is to do. So that obsession does not apply to the likes of Microsoft and so on. But it's I don't have it, but I do know plenty of people who do have this sort of fascination.
I'm looking at my portfolio, and I would say 80% of the holdings end with a 0 here, and then I can see where like Shell and Ahold, where I've been, or Unilever, where I've been, no, Ahold, where I've been hitting the reinvest button. It's like with an 8 or a 3. It really stands out in my portfolio. So yeah, this is funny. It's all with a 0 almost.
Val has asked me, when I'm out partying, do I only consume products from companies I own? No, is the answer. I was out on Friday and I was drinking Birra Moretti, which is owned by Heineken, and I don't have Heineken in my portfolio. So no, but I do drink Guinness quite a bit and Smirnoff, which are both Diageo prices. What I can tell you is that Diageo has increased their prices, which is coming into effect in 2 weeks' time in Ireland. Right in the lead up to Christmas, which is quite a busy period. They're going up quite significantly. I think they're putting a 20% price increase on their drink. So I'm expecting big things from Diageo in the first quarter of 2023.
A good one. Nice. Alexandras, he asked us about our thoughts of the ASML Investor Day. I have not had a chance yet to watch the recording. Also, I still have Intel in my backlog to also listen into. It has a higher priority because of my stake into the company. But Alexander really put his thoughts on Facebook, actually. So he's asking us, but he really shared great thoughts about it on Facebook. But Derek, okay, did you have a chance to look into it?
No, I did not. I did see Alexandra's not tweet. I know what you call a post on Facebook about it, which is quite in depth. So I'd recommend checking that out and then go and checking out the Investor Day straight after.
Nice. Nice.
Tim has asked us our thoughts on ticker symbol MPW, Medical Properties Trust. I do remember we had this question a couple of weeks ago, I
Yeah.
think. We started looking into them, but they've fallen off my radar. So I have
Yeah.
nothing more, nothing of value to add to this.
Yeah, and I think I asked on Twitter and Facebook about Medical Properties Trust, and I got too many red flags from people back that I even felt like, okay, I already didn't have a lot of love for the stock. It just got promoted to me a few times, so I felt like, okay, I'm not going to waste my time on it. And that's when I also started looking more into Cibus, CIBUS, in Sweden, which is a monthly dividend payer. I also wrote it in my latest post around quarterly dividend stocks. So I'm more looking into that one now as a potential real estate investment.
It does have quite a high yield. MPW, just checking, nearly 10% yield. So
exactly. That's why
be careful. Just be
exactly.
careful. Cohen has asked us, when did we start writing, blogging about investing and your journey to financial freedom? Do you have any tips to start with? I started maybe 3-4 years ago. I can't remember. But when I started Dividend Growth Investing, I started at pretty much as a journal. It has been neglected somewhat since I started writing for Sure Dividend, because I get paid to write for Sure Dividend, whereas the blog costs me money. So it makes more financial sense to follow the money, so to speak. But the only advice I would give you is be true to yourself. Stick to what you want to write about. Don't really care what anyone else says, or don't think about writing to the audience. Write to yourself. And the second thing is that it takes a lot of time. So in the beginning, you'll have loads of enthusiasm, you'll have loads of things to write about, but that will soon dwindle, and it takes time and effort to run a blog.
Yeah, so I did it. I failed the first 2 times. I created a blog on Blogger, the Google blogging tool, and I failed because I always was inspired with Jason Fieber, and I felt like, what he does, I can do as well, right? About my thoughts about the stock, right? And I would like to do it as well. And then I tried, and I wrote like 3-4 posts, and then it failed, and then I killed the blog again. And then in 2019 with Christmas, I thought like, okay, this is my last chance that I'm going to do it, and I'm going to commit 2 months to it, and I'm going to write 2 times a week. And this is my biggest learning, because what if you say this to yourself and you make the commitment, what you need to do is you need to start in your family, create space for this, that they see you behind your laptop. And your first articles easily take 3 to 4 to 5 hours, and mine even take longer. And that's why I'm posting a little bit less now, because I'm doing way more research at the moment. Yeah. And so, but if you commit to yourself twice a week, putting content out on a regular basis, you start changing a habit. And this is what really I noticed. I've changed my habit. And the other 2, when I reflect back on it, I was not able to establish a habit, and that's why it failed. And this would be my biggest recommendation. If you really want to do this, know why you want to do this. To your point, don't have high expectations from others. They will only read your stuff when you add value. Yeah. So, but you need to change your habit and create a habit of writing.
Billy has asked us our thoughts on VTRS. I think we mentioned above they had a decent earnings. They still have a fragile balance sheet, in my opinion, but they are paying down a lot of debt. They reached their target. The target for the year was 2 billion.
Yeah.
And they've paid 2.1 billion in the first 9 months. So they're really pushing that, which I like. The 2 acquisitions that I mentioned earlier on the show as well, I don't know an awful lot about the companies. I know they are expecting them to reach 1 billion in sales in the next 2 or 3 years, so that those look like they'll add significant revenue to the company. But overall, it was stable. We're still waiting for them to divest part of the company as well, which is obviously going to impact their earnings as well. So
for me, VTRS this year, if you don't take into account just the general price market drop that we've seen, and after last week, and with VTRS, I got this feeling last week like this might be the UPFI of 2022 for me. I bought, I think, UPFI in 2017 at $60-70. Many people hated it. They felt like biosimilars. I have the same I have the same feeling with VTRS. I don't. The stock is priced for me at the moment that I can't see it. I can't see it fail. I mean, they can fail on execution, right? But if you look at the 6 multiple, and with this cash flow, I find it really, really hard to see. I feel like there's hardly any downside pressure anymore for me when I talk about, not about price, but about value. Yeah.
Yeah.
Yeah. That's this
Yeah.
feeling that I have. I might be totally wrong, but I start to recognize, how I said, over the time, I start to recognize my own feelings more. And when when there was an opportunity, for instance.
Hopefully you're right, because I've got quite some shares in this, but we'll see. But I like the company. I think they're trading in deep value. So we'll see.
Yeah.
BT05. What do you guys think? Did the semi industry hit the bottom last month? It looks like ASML, LAM, and AMAT increased too much recently.
So I honestly don't know if they hit the bottom last month. If we now see what's all happening with FTX, what I notice is that companies like Nvidia, and I can't say that there is a correlation because I haven't studied enough, but it felt to me like when Bitcoin was at $69,000, and Nvidia was also really popular because they produce a lot of chips for the crypto industry. So I don't know, for instance, whether this whole crypto scandal that's now going on is also going to impact the semi industry. I really don't know. I think here's a typical example of prices, what you pay, values what you get.
Yeah, it's hard to call the bottom. I can almost certainly say that if I was to say this is the bottom, we would go 20% lower. So
yeah. Please say it. Please say it, Derek. Please.
So I'm holding off on that. I mean, I don't know, but what I do know is semiconductors are quite important, not just in crypto, quite across the world in different industries. So you do expect them to hold. We spoke about ASML, their strong order book. The other two I'm not as familiar with, but whether the bottom is in or not, it's hard to know. We do know there's these dead cat bounces. I've spoke on the show about the overlay with the crash in 2008.
Yeah.
Somebody again I don't know if they posted it in our group, and it's still matching. It's still matching, which is quite scary. And if it's following that trend, we still have a way to go. We're on the way
then
down.
the big crash should come now anytime. So
yeah, but what we are seeing is, I don't know about you, but we are seeing job losses starting to happen, particularly in big tech and all these. So I think we're getting close to it. There's loads and loads of talk of recession and fear. So I think capitulation is soon. I don't think, I'm going to say it, I don't think the bottom is in. I don't think we're there yet, but now I've said it, we're going to go to new all-time highs, but I think we're getting close. Job losses have started with some big companies, Microsoft, Facebook, Twitter, well, not even Twitter, but Tesla. All these companies are starting to lay off. And we all know when that happens, recession happens, but the stock market, we could be ahead. So we'll see. But I still think there's a way to go before we see the bottom.
Yeah, good. Well, that's actually also Jasper is asking about what are our thoughts about the performance at the end of the week resulting from the CPI number, and if we see the bottom. I have no clue. I really have no clue.
Yeah.
I do hope we will drop another 20 to 30% because I'm really, really angry on Johnson & Johnson to not give it up a cent even, while they don't deserve to be there, because I want to own more of it. So
yeah.
The only thing I can say is like such a response to 7.7% compared to February. That's comical. That's comical.
That's literally, I was just about to say. I seen a meme, and it's one of the funnier ones. And you see February 7.7%, and you see a man freaking out, and then it comes to November 7.7%, and it's like little party time. So it's fun, but it tells you perspective is everything, isn't it? From where you come from, when inflation was 0 or quite low, you hit 7%. There's panic. It goes to double digits and come back down. You're actually going, do you know what? 7% ain't that bad. So
exactly.
It's funny, but it's all about perspective.
Yeah. Hey, the next question is
Tiago. Yeah. What do you think of the ongoing train wreck at FTX?
We spoke about that to some extent. I mean, It was fun to watch, not for people that are invested. I think this will be a Netflix series anytime soon, and I will watch it with a lot of popcorn.
So you don't have crypto, so you're not going to have any accounts. So I have for my days I have Bitstamp, which is a European exchange, and I also have Coinbase. So I would have signed up to them. And it's quite funny. Yeah, I skipped my emails all weekend, so I got them this morning. But both of them had sent me an email saying, don't worry, if you have funds with us, it's safe, bloody blah and all this. You're kind of going, yeah, I don't think so, buddy. I don't think so. But it's quite funny though. There's a lot of panic out there. So
Yeah.
well, not funny, but quite interesting.
Yeah.
Mario has asked us for our take on Vopak, which is a Dutch company.
Yeah. So Vopak is a company in the, I guess, in the oil and gas industry, where if you know those big terminals where they store effectively oil, yeah, that needs to be consumed by society, let's say, and they're usually a little bit opposite from the traditional oil and gas stocks when it comes to volatility, because in times of cheap oil, Shell goes down, but then Vopak usually does well because everyone wants to store it for the future. Yeah, but Vopak, 20 years of dividend growth at really good numbers this week. I think actually Vopak is a really nice company to own, but you need to own it at the right time. And I would say you really need to look at the cyclicality of the stock and try to make a guesstimate when is a good time to buy it. I'm not saying about bottom fishing. I'm more saying when the news is bad around such a company that you're probably in a different part of the cycle. So that's when you want to buy Vopak. And I think it's one of those nice Dutch companies, 20 years of dividend growth or dividend stability, which is quite unique, right, in Europe. So far they've been proven to be a worthwhile dividend growth investment. Yeah.
Cool. Chris has asked us, have you ever considered investing on the Singapore Stock Exchange?
No.
Nope. I'm the same. I don't even know many great Singaporean companies.
Well, I think Singapore is being brought up a lot because of the relatively low dividend withholding tax, if I'm correct. And that's what might make it interesting for people to look at Singapore. Oh. So it's more like I'm already in Europe and America with Alibaba, maybe as a little bit of an FOMO thing. But I don't have a bandwidth to also go too much into Asian stocks, while I do believe there are really some jewels there, also in Japan as an example.
Yeah. Jan has asked us, have you ever considered adding some European corporate bonds into your strategy?
No, because that's what my pension fund is already doing. So, and I'm not counting too much on my future pension there. So why double down on that one?
Yeah. Okay. And finally, Gilly has asked us our opinions on Wisdom Tree Global Quality Dividend Growth ETF.
Well, first of all, Gilly, hi, nice to see you here again. I met him in Warsaw one time. We went for a drink, so that was really nice. I looked it up. This ETF exists for 4 years or something like that. I really like their holdings. So they have all the top companies in there, which is really nice. So if you want to own Microsoft, Apple, Johnson & Johnson, but also Nestle, Novartis, Roche, Louis Vuitton, then this is a really nice ETF. But again, the issue is with this is this is called, is it Global Quality ETF, right? Yeah, Quality Dividend Growth. So don't be misled by the title, guys, that when it says dividend growth, that it's actually giving you growing dividends. No, it's investing in companies that have been growing their dividends, but some of those companies might cut their dividends. Then there is also something when it comes to currency impacts. So if you look at the difference between 2019 and 2020, there was a slight dividend cut, if you would look at it like that. But overall, it has been performing quite well from a dividend growth point of view. So I think it's a nice ETF to consider at the right price. Yeah, so I think it's quality, but just never be misled by the title when it says dividend growth. It doesn't mean dividend growth into your pocket. It means they are investing in dividend growth stocks.
Good, nice one. So that's the last question. Thanks again to everyone for all the questions, and to Javi for sending in your portfolio review as well. Look, I think this was a nice topic with the week that we've had. There's a lot going on in the market. I've had to block lots of tweets in and around. I'm sick of, like, I've only logged in yesterday and today, and I'm sick of it already. So I'm blocking a lot of stuff that's going on. But for all of us that are in our community listen to this, I really hope that you are not affected, and if you are, maybe evaluate your risk going forward and what your plans are. But we'll see you all next week.